Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, December 1st, 2023. It is 11:21 a.m. Eastern Time as I'm starting the video. So as we head into the first trading day of the month, final trading month of the year, I wanted to do an update. And what I'm going to do, I've been under the weather recently. Got a little cold or something. I don't know. It's been the last few days. So I'll try not to cough into the mic. But I wanted to loop back since I've kind of been offline a little bit lately, just not feeling so great. I'm going to go and try to answer as many questions that were put to me in the comment section the last couple of days. There were some good charts, trade ideas. So here's what I'm going to do. I'm going to start out a very brief update. I don't want to be redundant. I already got a post out to you this morning. I'm calling it the big three now. I've always highlighted and tracked those, the relationship, especially in recent years. Again, there can be a disconnect. Stocks and bonds right now are positively correlated and have been for quite a while, really for the last couple of years almost. But historically, they were inversely correlated. So we watched that. Again, as you've probably heard, unless you're new to the site, I'm expecting at some point a disconnect and a reversion back to the old relationship where I can see a bear market in equities and bonds, possibly bond prices rallying or at least holding up. I'm not married to that, but I do suspect that is a likely scenario based on a lot of things, my fundamental analysis and technical analysis combined. Anywho, let me just get to. So here's QQQ. We took out S1 yesterday. These are the targets I gave you last week. T1 down here, T2, T3, T4, and nothing big so far. Maybe a little flagging action if you look at it this way. You have an impulsive leg down, i.e. a flagpole, followed by a level of consolidation, which takes the form of a flag. Measured target would be the widest part of the flagpole itself added to the top of the flag before it broke down. So that probably get us to T2. And I think that's a likely scenario. The euro, which is just basically the dollar in reverse, EUR, USD. You can look at UUP. You can look at UDN. UDN flips the dollar upside down. UUP is the dollar ETF. Or ETN technically. There's the euro at support. So there's, that's where the market bounced today. So these are the same targets. I haven't touched them. I gave them to you on Tuesday with the bearish rising wedge, maybe even before that, before it broke down. Hit T1, bounced. So you can sit here blindfolded, only looking at the euro USD and trade the stock market because the correlation is so good. And quite often you can get a heads up, and that's why I go over them all. If it were just exactly correlated tick by tick, why bother? Unless you're euro trader or dollar trader. But quite often in the markets don't realize that. The majority of market participants don't realize it. So you can get a heads up. For example, if you see interest rates, bonds break down and start moving lower because rates are going higher, and that happens for a couple days, or the euro starts to fall. And that was a pretty big drop there. And so the stock market maybe initially ignored it or didn't fully price it in. And so that's the takeaway, is that if you see one of these things going one way, especially a big move, and the other things like the stock market or bonds, they don't get the memo, then there's usually a mean reversion there, or a game of catch up is more accurate. Whereas either, if the breakdown in euro was a false breakdown and the stock market continues to rally and yields continue to fall and bonds rally, then you'd see that. Otherwise, like I said, it is what it is. And again, these are just the ways active traders can kind of time entries and exits on trades. Each of these targets I list are areas where you're likely to get a reaction, and that's what a reaction is. You hit a target, you bounce, and you break it. And once once that target's taken out, that opens the door to the next target, and you bounce. And so where do we go from now? Well, we can look at a few things. We can say if it's a pretty good size bounce, maybe all the way up here to that downtrend line right there. I think that's a reasonable target. There's also a couple reactions here. So now I'm going to add another line right now. I can see some reactions there on the candles and then the bounce. So this would all be, and of course you have a reaction low right there. So really this is the range, if you will, of the bounce. And so if you are, there's 101 ways to take this analysis. You can be trading the currencies. You can be trading the stock market. But if you are and you're looking to add to shorts in the stock market. This would be an objective level here if we get there. But again, you got to take all the charts collectively, because maybe the euro goes this far right here, a little shy, but then QQQ, for example, hits resistance and then it turns. Then the euro may never make it there. So a little divergence here on the 60 right there. Almost, so I'm going to call it divergence there on the RSI as well. Almost an equal low, slightly, ever so slightly lower low. About an equal low, so maybe we could get a little healthier bounce here. We'll see. Either way, that tells you that's not a good time. If you didn't want to short the euro or the dollar, or QQQ back here before it dropped, this is the euro chart, but it certainly would not be objective to do it right there. So again, that's why I get these levels out to you in advance. I highly recommend you, if you agree with the analysis, keep those charts up and watch them all. So there's the euro. TLT. Sorry, I had a little coughing bout there. TLT is highlighted in what was the video on Wednesday. Hit T3, and there's the reaction. Not much of a reaction so far, but still at T3, as I like to say, resistance is resistance until it's taken out. So if you were looking to exit, you're considering booking profits. We've been long treasuries 30 years since back there on the breakout. It's still an objective level. Still can't rule out, nor have I removed that target yet, final target. I just suspect we'll probably do this first. Again, it all depends. That euro, like I said, I just showed you positive divergence. Maybe we could bounce some more, but I do still favor a bigger correction. At least, I think I gave you this on Wednesday, 89.65 minimum pullback target. Could be more than that. And again, I always say the markets are dynamic, and so are the charts, the technicals, meaning they're constantly evolving and changing. So, watch this. I may, maybe we don't have the pullback yet. Maybe we go all the way to a T4, and then I'll be talking about the same thing that I'm talking about now, especially if the divergence is still intact. At that point, I'll be looking for an even bigger correction, because that's even bigger resistance. That's hence my final target. Okay, so that's the euro. QQQ, I'm sorry, that was TLT. QQQ, 60-minute chart, I already covered that. Yep, I did. A little potential flagging action. Now let's move on to, I want to show you two other charts I haven't showed you in a while. And then I'm going to get to just go through, there were some good questions, a question on trade updates or different things. Some aren't actual trades right now, at least not for me. Somebody brought up solar stocks, natural gas, GDX, all that good stuff. So we'll get to that in just a second here. Okay, we're going to jump now to the big picture. And one of the most important things that I always try to convey and reiterate on the site is the difference between long-term, bigger picture analysis, where I think any particular security, commodity, the stock market, a stock, an index, where I think they're going in the longer term. That helps me to formulate how I'm going to trade shorter and longer term positions. But when I'm focusing on things like I started this video with 60-minute charts, and sometimes I'll go down to the shorter 15-minute, 5-minute, those are called intraday charts, and I'm speaking to moves that are just a few percentage points away. That is short-term analysis. That is swing trading. That is I might be foaming at the mouth bullish, gold one day, and for a couple of weeks focusing on some short-term developments on the short-term charts, but then longer-term bearish, expecting more downside, just like the stock market. You have, big picture. So I'm going to go over big picture stuff. And this helps formulate, my unwavering longer-term bearish outlook for the market, which is, I know I'm not the only one, but I know it's a certainly majority view now when you turn on, CNBC and you read, what a lot of folks are saying. They're talking at best maybe a soft landing, and a lot of folks have ruled that out, especially in the last month or so with the pullback in treasury yields. However, all right, so this chart speaks volumes to me, and again, I've covered it many times in the past, but not recently, and just bears repeating. So I heard recently, I didn't verify it, you can go to Google search federal funds futures, what is it, the Fed probability. I have it bookmarked, and it'll give you the actual probabilities, which are hard numbers. It's not any type of sentiment survey. It's based on positioning with the professionals. Most people listening to my voice, or people, friends, family, they don't trade federal funds futures. Those are professional traders, i.e., the smart money institutions mostly. And so that their positioning will show, and they're highly accurate, highly accurate. That's where we look at what the probability each time for a rate hike is. And so now it's almost a near certainty that the next move will be a cut, and that the hiking cycle is over, right? So this never fails to amaze me. I mean, there's folks older than me that have been in business longer, and they get marched out onto bubble TV, Bloomberg and CNBC, and they're talking about, making the bullish case because the Fed hiking is over. Hiking cycle, and the next move will be a cut. Again, that's across the board unanimous. That's not my subjective opinion. It's fact. It's what the markets are pricing in. But yet, history clearly shows us that recessions, if you can see this chart, I think you can see, hopefully, you need a new monitor or a better phone with better resolution. These shaded areas are recessions. So you got a recession. And as you can clearly see, after a hiking cycle, the Fed fund rate peaks, then the recession comes. So if you want to look at a timing indicator, if you want to sit there, and again, what I'm amazed at is how they spin this as being bullish because the Fed's now going to cut rates and the hiking cycle is over. Well, that almost, with a few exceptions, without fail, and you're going back now into the 50s, but in the modern, in the past half century or more, you can clearly see after a Fed hiking cycle, they begin to cut. Then comes a recession. Now we can also know this: recessions are declared in hindsight. By the time the recession, half the time, by the time that it's actually officially declared, it's over. Remember, recessions are 2 quarters of contracting GDP. GDP is put out quarterly. There's a month lag before it comes out. Then there's always revisions after the fact. So it can be, a recession can and sometimes be over before they've actually declared it an official recession. But either way, just take a look at that and go back all you want. And there's a peak before. That one was concurrent. That one came in. But most of the time, again, I'm showing you the arrows. You can get this. You can Google search. This one's from macrotrends.net. And that's it. So, it's pretty clear, right? So there's a recession coming. I have very little doubt about it. Of course, it's not 100% certainty, but I don't think it's going to be a soft landing. In fact, I think it's going to be very prolonged, whether it's going to be a crash type thing that comes or just long term. But I do think it'll be a multi-year, and it'll also, the shaded box, I think, is going to be a lot bigger than these previous recessions. We're in a different era. Why do I say that? It's easy to just make a big prediction. Excuse me. Again, this is basic economics and financial markets 101. If you go back and look at when interest rates peaked, think Reagan coming into office, Carter and the high inflation era leaving, we have been up until this point right here in the biggest secular bear market, meaning falling interest rates in history. These were rising rates back here. And so it's, by many metrics, even if you look at the federal funds rate, what's a downtrend? A downtrend is anything making a series of lower lows and lower highs, right? Well, we went to zero. There are no more lower lows. The Fed's made it clear, and I agree, they can't go to a negative interest rate policy. There's a lot of reasons why, even if they did, technically it'd be like you're talking a mere fraction of percent. You're not going to go to negative 5% federal funds rate, right? So it's over. And now only in hindsight, when we have a series of higher highs, we've already taken out the 2 previous highs. So, we'll see, that move down. But I think the trend is going to be like this. Don't take my word for it. You can simply go to any chart you want and pull up. We'll do TNX, the 10-year yield. And you just go to long-term chart and roll back. Again, these are things I covered a lot, but it bears repeating. There's always new folks coming in. There's your interest rate cycle. There's 1981 when rates peaked, And so make no mistake about it, the primary, by far, driver of the super secular, strong secular bull market we've had in equities coincided with this secular bear market in interest rates. And as I've mentioned, by just about every metric out there, that marked the end of it. And we're most likely in a new secular bull. But this is a monthly chart. Like I said, I've made the case we could see a multi-month pullback in yields and still very much keep, my max target, which is still very doable, is come on and back test the primary. That's the primary downtrend line off the peak back in 81. That'd be a big drop in yields. And so will it be bullish for equities? It could. On face value it would, but not if it's a flight to safety bid. Nobody wanting to buy treasury bonds, knowing that the only way that our government's going to get out of this mess is by a technical default, or printing money. Not they're not going to stop paying their bonds back in the interest, but they will just print more money, print more bonds to pay for the interest on those. So anyways, there's a myriad of possibilities there. I will treat these mutual exclusive. I do, in short term, they go into my analysis, but that's that. So, okay. So just want to make clear that, the guys and gals that come on TV and talk that this is going to be bullish, there'll be a reason why rates are going to be cut. And there's a reason why there's 100%, near 100% certainty they're going to be cut next year. That is because we're going to be in a pretty ugly situation in the financial markets, whether banks are breaking, non-financials are breaking, hedge funds, there's problems with municipalities. It doesn't matter. The U.S. is still, our debt servicing costs are going way up. Again, it's priced in right now, and those Fed fund futures are pretty damn accurate. So that's that. And by the way, they're infinitely more accurate than what the Fed says. So take what Powell says with just about the biggest lump of salt you can. The Fed's always been proactive behind the curve, and to be honest with you, kind of clueless. That's my opinion. You guys might have your own. Okay, all right, Randy. Okay, maybe you make a good point there, but we'll see. Maybe this time it's going to be different. Sure. Here's another one. This is, I need to shrink this over here, get it back into the view of the monitor. Give me 1 second. Okay, that should work. This one I get from Guru Focus, GURU Focus.com. It's got a nice section on the Treasury yield curve, as well as some educational bits about it, why it works, how it works. This is which one is this? The 10 year. Oh no, that's not the yield curve. Where'd it go? I've got it up here somewhere. There it is, guys. All right, let me see if I can zoom in for you once more. That's what I was trying to do and took it away. All right, close enough. I'm just trying to make sure you can see it on the videos here. All right, so an inverted yield curve has predicted the past 7 recessions. This indicator, remember I always say that there's no one indicator that's 100% effective. If there was, we'd all be millionaires and billionaires just sitting back using it, letting it dictate our, just grow our portfolio. Well, this one's got about as good a track record as any, and basically, so once the yield curve inverts, see the zero line, that means is the 10-year Treasury yield has dropped below the 1-year yield. There's reasons I can get into it, but including, not limited to, the markets predicting weakness in future economic growth, hence lower interest rates, recession, all that stuff. And, I and others have talked about it for a long time. And, it got the last recession. It inverted before COVID even hit, and knew it was coming somehow. You can see it's been accurate. Again, go back, go to the site, read it. This is well known. Now, here's the thing. It's not a timing indicator. And in fact, if it is at all a timing indicator, the takeaway is, and this is in every instance, the recession doesn't come once the yield curve inverts. It always follows. But what happens, it's the uninversion. That's what they call it. I don't know why they don't call it reversion. Maybe that, the technical term is uninversion. But that's when it follows, shortly after the uninversion. In other words, when the short-term rates then long-term rates pick back up and cross back above and are higher than the short-term rates on the 1 year. And so you can see it, again, without fail. Where are we at? Well, we're certainly getting closer there. We haven't uninverted yet, and this is the spread on the 10 and 2. Sometimes I'll look at the 10-1, sometimes the 10-year versus the 2-year, and again, you can see here, and you can see it's the uninversion that you're getting a lot closer to the recession, and so there it is. We haven't uninverted yet, but we're certainly trending that way. So this again is pointing to what the federal funds futures are. Okay, so the exact when, who knows? Like I said, we can try to anticipate this uninversion, and it's something we're going to watch. We're going to watch Treasury yields. You can just sit there and keep your eye on the 10-year and the 1 and 2 year, and that's what we'll continue to do. So, anywho, that again just reaffirms that the probability to me is extremely high that we are going to. The U.S. economy will be heading into recession, and it'll be an imminent recession. Imminent, the word imminent is relative. It's relative to the time frame you're talking about. Again, you're looking at a chart spanning decades here. So imminent doesn't mean today, tomorrow. When I, 5-minute chart, if I give you a bullish chart pattern, and I say I think a breakout's imminent, yeah, that means within a week, within days, maybe even hours on a 5-minute chart. If I'm looking at a monthly chart, a weekly chart, where I'm talking about a major call, such as a recession, imminent means it could, we could hear about the recession starting in a few months, or it could be, a year, 18 months. It's really, again, it's not a timing indicator. Although when we get the reinversion, that will tell us now we're even, the recession is either probably in play, which it usually is at that point, or much closer to taking hold. Okay, now let's roll into, I'm going to go back 2 days here because I noticed that this post had a lot of comments and I haven't gotten to those. I'll try to just answer each one. It's more efficient than going in and typing and screenshotting charts for me. So, okay, I'm just going to go through these in order of as they were posted. I've seen in the past where you said you give more weight to the longer term charts versus a shorter. The daily PPO crossover looks imminent, as you have said. However, QQQ did a bullish PPO on the weekly chart last week. Not sure if you saw that. Thoughts? Great question. I love this one. Let's take a look at that. Okay, QQQ, if you missed it, daily chart, as well as SPY. You can look at SPY. I'm going to turn off all the little lines here for a second and go here to put up the PPO histogram. So I mentioned it, you don't have to, have a PhD in technical analysis to spot a trend. This is the PPO, meaning the signal line. This is your PPO line in orange rolling over. It's just, as I mentioned, I covered it the other day. I don't want to get into too much detail. The histogram just shows you when the PPO, which is down here, when the lines cross, make a bearish or bullish crossover, and that's when they cross from green to red, right? So now we have the cross, although the day is not over. This is a daily chart, so it's at negative 0.02 now. If we close the day right where we are or lower, then we get the crossover. If not, it still looks imminent to me. Again, you can see there's no guarantees. Sometimes they look like they're going to cross and then they bounce, but again, normally you can see it going down. The crossovers typically come, right? There is a case where it looked like, but it didn't even get that close to the zero line yet. It bounced, and then the crossover came, and so I went over that recently. Okay, so that's the daily. We have it there on QQQ. Well, we'll see. Depends how the day closes. SPY's got a little work to do. If you look at the equal weighted indexes, RSP is a little stronger. That speaks to market breadth. That's actually a plus for the bulls there. Same with QQQE. So the equal weight is a little stronger. However, this, if they take out the generals, see the generals are now showing weakness. And you can spin it one of two ways. You can be half glass empty, bearish meaning, and say, well, if the generals die, then the troops are going to follow. So that's why QQQ is, right now crossing over because the market leaders been heavy. However, glass half full says, this is healthy rotation. They're just taking a breather, and the rest of the stocks are strong. QQQ first and foremost is what I go by, because again, those leaders, if they go down, they will take the rest of the lot with them. So that's my take. All right, let's go back to the original question. So the daily chart, the PPO crossover there is in effect. We'll see, pending again a daily red daily crossover at the end of the day today, or any day in the next couple months. We'll see. This is a weekly chart of QQQ. Busy board. Let me turn off all my levels. Just the same stuff. We have the negative divergence. Remember my alternative scenario for months now, alternative marginal new high. That's certainly in place. So here's what we're going to look at. We're going to put up the histogram, and there's that bullish crossover. And again, great question. So here's my take on it. If the daily chart plays out, which I think it would, I've showed you a pretty reliable history of these bearish crossovers marking inflection points, and you have the negative divergence and everything else. It's not on this board. I have it on this board. Negative divergence, marginal new high. So by this chart, it tells me with a pretty high degree of confidence. Again, this was my alternative and now primary scenario that we're going to go down. So therefore, if that plays out, which I suspect it will, then what you're going to have here, let me see if I can move things up. You already have a divergent high on QQQ. And you could certainly go up a little more. Like I said, a marginal new high entails that high being anywhere from, just above the previous high up to 5, maybe 8% tops. And there's some resistance overhead. There's the previous bear market, last bull market high, the start of the bear market. And that's still within, what I call spitting distance. So, we could go up a little more. If we do, I want to show you what we'll have here on the weekly. You already have strong negative divergence, but the divergence that I love to see, or I really prefer to see, I should say, is what I call clean separation with two distinct peaks or troughs. This is bullish divergence, and you get a bullish crossover. You have a trough there, followed by a move up, and then another leg down with a distinct higher low. That's what we would have. We don't even have, in my opinion, I like to see that bullish crossover and then another cross down. And you can see we had that here. We had a couple crossovers. See, as the market was topping, if you study the PPO back here, I'll do it for you. You can see we had cases where it would cross over and then cross back down. Crossover, it couldn't hold. So I think we'll see something like that. I think this crossover here, which has in play, it gives us what I wanted now, the two distinct crossovers, and if we get any, even at this point, technically it's negative divergence, but any new high, probably be a marginal new high again in QQQ. Right now it is, could be a little more, and that will give us, it's strong negative divergence. So this tells me with a high degree of confidence that whether we go up for a couple months, couple weeks, or really it's in percentage terms. I always say, make a lot of stuff up, but I say there's a big difference to me to being early or wrong on a trade. Early means you get in, and as long as we don't go up, another 10, 12% above that previous high, and then we do roll over and we do go down to those longer term, deeper targets, then I was early on the call. If we go up and bust on through there and keep going, and we go up above that high and we're up, another 10, 12% above that previous high, and then I'm just wrong. That's it. It's as simple as that. So that's it. So based on, my expectation in looking at this, yes, you have the bullish crossover there, but again, when the technicals, especially on the daily chart, confirm that the upside's limited, you're probably going to get one of these very meager crossovers. Again, I should have it on the histogram for you, and I do. See, come a crossover and it just fails. These are whipsaws, they're called. And so I think this will be a whipsaw right there. Okay, next up. This is a couple days ago. I saw a huge VIX spike today, immediately came down. Any thoughts on that? No. The VIX, it's noise. Where volatility is starting to expand. The VIX it's really nice setup. I pointed out the other day. And so when volatility increases, the VIX is the most volatile thing. I don't think there's anything more volatile out there than the VIX. Even natural gas can't hold a candle to the VIX. So markets are starting to show increased volatility. You're going to see the VIX move around. And that's that. I just can't, I always say one day doesn't make a trend. So it didn't have any technically significant events that day, I don't believe, like a breakout above a well-defined trend line or horizontal resistance level or support level. So again, I try not to read too much into that, especially on something like the VIX. Thanks. I'm choosing to stick with gold and the gold miners here. Individual charts and sentiment are going to count more. Yeah, I like, fundamentally and even technically long term, I still like the metals and the miners. It will be a headwind. It's not a guaranteed move down in gold and GDX when the euro corrects, but they are highly correlated. You can look at that again. I've spoke to that many times. It's simply the fact that the gold, at least we're trading here in the States, is priced in US dollars. So when the dollar goes down, it takes more dollars to buy an ounce of gold and vice versa. But there are supply and demand things that can offset that. But for the most part, you just want to, ideally, the best trades in gold come when you can make a strong case for a drop in the dollar, i.e. rally in the euro. And so, yeah, no, long term, I like gold. I think it's for a long term portfolio. Precious metals and even the miners, I think have their place for sure. Anybody want to try to catch a falling knife? Nat gas. Okay, a couple questions on nat gas. I agree on this. Jeff says there's just you can't. UNG over time is just going to go down in value. It's an ETN that's rolling futures, and therefore it's incurring costs. It's not the you can trade nat gas futures or ETNs that trade the futures. All right, I'll get to nat gas here. Let me just do that since there's a lot of comments on here and a request for an update. All right, here's a 60-minute chart. We've got a nice little wedge setting up here. And what I love to see, and we actually can go back this far on the divergence. So we've had divergence building. Natural gas is can't seem to catch a bid lately. It's in a downtrend. But big divergences. It doesn't go to zero. You can look longer term if you want and, go back. These are natural gas futures. But so it's really down below the low end of that trading range. But I suspect that'll probably be a whipsaw. And then going back to UNG, which I know a lot of folks trade, and somebody said it in the comments section, that same thread I was just covering, until and unless we take out, remember this was, let me park the histogram again, we're done with that. Busy board here, but I've highlighted, we have this trading range right here we've been in. And we've hit, it was a trade from back here, divergent low, rallied, we hit T1, T2, and all the updates along, as somebody said, we got to take that T2 level out. Now, I will say this, as time goes on, because of that decay that you have, it's not tracking natural gas or slippage and all this stuff and fees, you really want to keep an eye on natural gas futures and or spot price or whatever. But there it is. So it's still about, roughly $8 it needs to take out. And, you look at the 60-minute chart, you've got nice divergence. This is a nice setup. I have to say, there's no buy signals. If it takes that wedge out with conviction, sure. I showed you a second ago on the futures. It's not super, look at it this way. It looks like it broke out there. So, yeah, it's a buy right now. Here's what I would do. Buy it, set a stop, little just below, tight stop, let it run, A big old gap right there in UNG, and I'll follow up maybe with some targets on NG, natural gas futures. But it looks good here. Certainly oversold, and I think this also looks like, by the way, guys, it looks like they've puked it up right now, meaning capitulation type thing. It's been going around in that range for months. Remember, that was a whipsaw, false breakdown below the range. Well, the range, we were making stair-stepping lower, then we recovered the range, we bounced around in the range, and natural target would be the bottom of the range again. But if we can get back up in the range, that would be bullish. And then, of course, take out those previous highs and look for the highs again on nat gas futures. You want to see those previous major reaction highs get taken out. Okay, moving on down. That was all natural gas. Any chance QQQ is correcting over time? Good question. I think what the Fuhawk's referring to is, I always say there's, two ways or a combination thereof a security can correct. So if something's going up, a correction means going down or moving sideways for a period of time, or maybe a little of both, a little down, but not too much, mostly sideways. That's certainly a possibility. And it's been 10 days trading on the island. Well, first of all, remember, they're referring to the island potential. I can't say that enough. Just like any chart pattern, bullish or bearish chart pattern is a potential set up for a long or short trade. But if it's untriggered, it never materializes. So let's go to the daily chart, turn off all the lines. So this is that island right here. It's still an island. It's getting, like I said, long in the tooth, but it's still an island, meaning, well, no, I'm sorry. I'm so sorry. It's not an island. It would be an island if you have another gap down. Then you have the island top, right? Because an island is a cluster. Island cluster is a cluster of candlesticks separated by noticeable, distinct, good-sized gaps on both sides. So right now it's only potential setup and not that. So, if you short the island for that reason, well, you don't, you can be short the Qs for other reasons, but we don't have a sell signal on a gap down right now. We don't have the island, but it's still something to look for. All right, next one. I learned this one from you back in the day. Gold, looks like parallel channels there, and it's walking up the channel. Potential channel. I wouldn't, put too much on that trend line. I think that's what they're referring to here. And maybe it continues to walk up. Like I said, watch the euro. We could get, charts indicate likely another leg down. And if that's the case, then it's just gonna create a headwind for gold. So I don't, right now in the trading account, I don't have any position there. Oh, next one. Sorry, clicked here. Let me get rid of that. Same one. Says, what do you think about some marijuana? Here, let me look at my chart. It looks the same. I don't have an opinion on it. I can't make a case. What was that? MSOS, I think. Yeah, the U.S. Cannabis ETF. There's a long-term downtrend line right here. Potential long-term downtrend line. I've actually had this one for a while, and I just extended it. So we're below that. These are low-quality, low-tier stocks. If the market rolls over soon, see, junk has been doing well. When you have a rally like we've had in the month of November, a strong rally in the market, it brings speculators back in. So crap stocks, the most oversold, beat down, highly shorted names tend to outperform. Fundamentals on a lot of these cannabis stocks are questionable. These lines I haven't changed. I've had these divergence lines here drawn for, this was back in September of this year, I'm sorry. So I've had it for months on this, looking at the divergence. I must have pointed it out back then. Again, I haven't modified that trend line. I created that back on September 7th. And that's it. So I was, highlighting the divergence. Then we popped, but we're still, and there's a lot of volume lately, big volume in this ETF here. There's my levels. Look, all I can tell you is I'm passing on it right now. If it pops 721, that's horizontal price resistance, and then that downtrend line, there's a little spike above there. I'd probably, to be safe, that's what I need to do. That's a better trend line fit. Why? Because I'll leave it there. I'll show you why. I had that high, and I just captured. I had it a little bit below there. Now that's a better fit. That's a good trend line right there. I would replicate that when you have 3 distinct reactions. Set an alert, and then who knows? Maybe these guys start to run. Again, 721 should pop it to the trend line. Probably get a reaction if that happens, and then 1005 first target, 1321 second target. MJ is another one, first to market. Similar technical posture here. But again, if we're heading into recession, the lag effect, everything I covered in the earlier part of the video, I didn't really say it out, but that's with that Fed funds rate hike, and then how the hiking cycle stops, and then the recession comes. That's the lag effect, and these rising rates hurt smaller companies more than large cap companies. Apple does sell bonds, they do borrow money, but not because they need to. They have more cash than they know what to do with. They do it because they could, because the government was brought rates down to near zero, and they could issue bonds at almost nothing and turn around and then buy their stock back with it. So in other words, Apple can weather, stock's going to go down, don't get me wrong, it's a growth stock during the next recession, but they're not going to go bankrupt anytime soon, right? Where a lot of these smaller, lower tier companies can. So you just got to be careful with them. Don't fall in love with them. And they're really not the type of companies you want to be going in unless there's some fundamental catalyst. We'll keep an eye on them. Feel free to bump me later. Like I said, I just gave you levels on that other one. And I'm certainly glad to answer any updates later. Solar power. ICLN. I wasn't familiar with that one before. I've always traded TAN in the past as a solar ETF, but this one's the iShares Global Clean Energy Index Fund ETF. Let's take a look. Okay, here's my chart. It's got a pretty clean downtrend line. We're quite a bit below it, but there's two things when I give you a trend like that. Number one, it's a potential target, and there's nice support. That's really good. Look at those two reactions there, a little brief whipsaw followed by a recovery and a big rally above it to prove it was a whipsaw on an important level once it was recovered. Another distinct reaction. Take that line across, it intersects perfectly. So, okay, and positive divergence recently and a breakdown above the downtrend line. So I have to say there's nothing I don't like in this chart. It's got some moving averages here. It's about to clear, and I don't see a lot of resistance. That would be certainly a potential target, especially if the market holds up or this sector. Sometimes maybe one sector can rally. This is kind of an obscure sector. There's a lot of government manipulation and control, subsidies, supporting this sector, but that would be a 19% rally up to that level. All I can tell you that's like I said, it looks good. Again, I'm kind of concerned about the market, so I'm being a little extra selective on things, but there it is if you want to take it. Just to digress and talk fundamentally about the sector, I'm far from an expert, but I read an article this morning from the Journal, and it was actually an opinion piece, I should clarify. So you can verify these facts if you want. Germany gets honest about what net zero will cost. So basically, to try to recap it, I'm just looking at the article here. Okay, so Germany's highest constitutional court ruled in mid-November that Berlin's favorite budget gimmick violates the balanced budget amendment. So the amendment is known as a debt brake. So in Germany, which is, of course, one of the world's biggest economies, they have an amendment known as the debt brake, which says it limits the federal general budget deficit to 0.035% of GDP in any year unless Parliament declares an emergency. Great way to balance your budget, right? U.S. is spiraling. Our debt to GDP ratio is spiraling out of control. Highest levels that we've been in, I think, ever in non-war time. So God forbid World War III does erupt, and where do we go from there? Our debt is already exploding at, normally levels only seen in wartime. So anyways, so that sounds great, right? Okay. However, excuse me, they passed that amendment back in 2009, but they say budget discipline has been a potent political issue in Germany for decades. Politicians love to promise fiscal restraint, but they hate to abide by it. So what they did is, clever as they are, the politicians, they established a go-around for that whole debt brake amendment. And they have something called, let me try to butcher it in my best German, Sondervermögen, and which is that allows special funds with their own revenue streams and borrowing authority so the government can shift a portion of those expenditures off its balance sheet. So very slick, right? And it's a big portion, they say. There are now 29 of those special funds, with the largest of them allowed to borrow and spend over multi-year periods up to 869 euro. And so it's all backstopped by the taxpayers, and none of it is folded in the general budget. So anyway, so where it goes, I won't read the whole thing. You can look it up if you're a Journal subscriber. It makes sense that they go on to talk about how the cost of green energy and this whole net zero thing it's unsustainable fiscally. The cost is tremendous. The amount of subsidies required, we're just not there yet with the whole green energy and windmills and thermal energy and all that. And Germany took a lot of their nuclear plants offline, a few years back. So they're basically saying they're going to get to a point where Germans are probably going to, again, it was an opinion piece, just realize they don't think net zero is as important as they think. So therefore, that would be Germany, and I have to imagine, again, one of the world's largest economies, and if they start reeling in, pulling back in some of those subsidies that are keeping these companies going. But again, that's macro stuff. It's longer term, just something to keep an eye on. You could certainly rally 20% before any of that's even priced in, even if it does start to happen. So, like I said, take it for what it's worth. There's a chart. I just wanted to share that fundamental tidbit because I got this question today and I just read that article. So, Okay, just trying to cover them all here, guys. And Nova from the same solar company. Yeah, that looks nice. Let me see. I think I marked up a chart too. Nova, NOVA. Grab that chart. Again, it's another solar company. Yeah, similar. I have one that was major support right here. Major, and then a breakdown. And so we're coming back to there. So a pop back above it would be bullish. However, as I like to say, resistance is resistance until that's taken out. You had a divergent low recently. I wish I would have saw a lot of these companies off that divergent low. It's been a nice rally, but I didn't. But either way, there's your levels. But I wouldn't take it here. You got massive resistance coming up at 1260-ish. If it can pop that and stay above there, sure. Otherwise, we're in a bear market, I believe. And this, you say what you want about it, and you cannot argue no matter who you are. It's not debatable whether this stock is in a bull or bear market. This is by definition a bear market. The stock is down 86% or was at the recent lows, and a downtrend is simply defined as the security making lower lows and lower highs. That's what this thing is doing. And until unless proven otherwise, the trend is your friend. So bigger picture is what I'm trying to say is, the odds would favor a rejection there, or at some point before it takes out that previous high right there. And just one more kind of tidbit, a side bit on that. So we know we have massive subsidies of Biden's big green plan and what I just mentioned about Germany that haven't, they're still, and this company is not doing well. It's down 86%. So if you're trying to, here's how I want to frame this. If you're saying, Randy, my God, this company's down 86% or was recently, how much more downside left? A lot. Some of these companies will go away. And my God, if you pulled the subsidies out, I don't get it. I have no idea. I'm not an expert in this sector. I don't know how much subsidies this company receives. When you start reeling those in, we go into recession here and things get really ugly. That's just less money for the budget. What are you going to do? Take it from the social programs? We know that's not going to happen. So money's going to have to come out of our budget somewhere. So keep that in mind. There's no limit on stocks. So zero is always a limit or the downside on a stock. I'm not saying this one's going to zero. I just want to try to have that open mind that there, just because it's dropped 86% doesn't mean, this isn't like wheat or natural gas like I talked about that doesn't go to zero. That's always going to be around at least for the foreseeable future. And it is, there is a limit. It's not going to. Wheat doesn't declare bankruptcy. It'll be around. In fact, I'll get to that one in a second. Or maybe in the next video. I did reply to somebody the other day about wheat. I like it. I put up a chart. If it's in a different thread, then I have to wrap this video up soon. We're already at the 47-minute mark. Looks to me like GDX is inverse head and shoulders and can pop to move up. Yep, I agree. Like I said, it's chart's a chart because the dollar may or not rally here, or pull back, or rally if the euro drops. I'm sorry. That's just a look. Here's a case where it's strong. We took out. See, you had negative divergence recently, and we took that out. We just made a new high. There's one of those examples where something so strong powers through divergence that was a divergent high at this point. Technically speaking, now because we've exceeded the prior highs, it's not. But that's not the chart I wanted to show you. I wanted to go to daily here, and there's that inverse head and shoulders, and sure, left shoulder. Head, right shoulder, very symmetrical too. They don't have to be perfectly symmetrical, but that one is. There's your neckline breakout, and it's not just like we limped above it. It was a powerful breakout candle. I think I highlighted that recently on not with the inverse head and shoulders, but that this was big resistance right there, and we had a powerful breakout. So that's that. And, when you have a head and shoulders or an inverse head and shoulders in this case, which is the opposite, it's a bullish pattern. Head and shoulders are topping pattern. You take the distance from the neckline up to from the bottom of the head to the neckline, and you add that to where it breaks out. That's your measured target right there. That's how you do it. Okay, gosh, like I said, a lot of questions here, and I just wanted to answer them all. And I know there's some additional ones that have been here since. I'll try to get to those, but it won't be in this video. I don't want this one to go over an hour. With today's gap up, can we expect that imminent 3-week or so divergent trend to change to get more imminent? Yeah, sure, it's possible until the divergence is taken out. I just addressed that. I just addressed it with GDX. We take out the divergences, and not just in QQQ, but on all the indexes on the daily. That's bigger picture stuff. Yeah, that's nothing but bullish. But right now we still very much have them. We have divergences on the 60-minute, daily, and weekly. That's what we had when we first shorted back in November of the QQQ initially back, and it peaked in November. And looking for a bear market because of those longer term divergences, not just another swing trade on the 60. So I know that's a little cynical, but that to answer your question, yeah, certainly we could go higher, but right now we've been falling. Natural gas. Okay, I already did that. Got natural gas for you there. Natural gas. Yeah, and somebody said the same thing. We need to break above a certain level. Small, let me see this one. I didn't read this one yet. Small caps hit the 200-day simple moving average again, while the Dow Jones, hey kitty, hold on, cat's screaming here. While the Dow Jones makes new highs and new highs. In addition, okay. Oh, that's just something is going on. Okay, that's not a question. I'm sorry. It's just kind of an observation thing. If the Fed is going to start cutting rates before the market has collapsed, it is going up massively like Singapore market. Okay, well, I already addressed that, I guess, in the beginning of the video. This was just kind of somebody's commentary or observations of the market. But like I said, yeah, the only reason the Fed's going to cut rates is if there's a problem. And that's what the markets are forecasting. They're forecasting rate cuts. Why wouldn't they? Think of it this way. They've not even normalized rates. They still look at, but we're much more now back to a normal rate environment historically. So what would prompt the Fed to cut rates? The only thing that's going to prompt them to start cutting rates is a problem, i.e. the economy is starting to roll over, unemployment continues to creep up. The trends have been moving up. I know this video has gone long enough. I've covered some of those. Yesterday, consumer spending is slowing now. We had this, what was it, the 15th consecutive week reading on ISM, I think it was today. It's in contraction territory. So there are a lot there. And that also contradicts with GDP, which is still strong. But GDP is, again, subject to hindsight revisions. And anyway, so a lot of the leading indicators are starting to show that we are clearly slowing down, and so that's that. Anyway, I'm gonna wrap it here, and I know it was a long one, and I'll do the same. I'll try to get to the other questions individually if I don't cover them in the next video. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.